everyone. Thank you so much for joining us today. I'm Marche, the webinar director at Advice Chaser. We're so thrilled to have you here. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own and, however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the webinar presentation today as appropriate. We do have a question and answer period at the end of the presentation. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to your question, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our speaker today. Todd Shield is the Regional Vice President of Peterson International Underwriters. He has been in the insurance industry since 2006. Peterson International Underwriters markets its products through licensed insurance professionals, helping them realize the crucial fact that to have one's income underinsured is as dangerous as not being insured at all. Eventual financial ruin is the ultimate outcome. Through education, training, and marketing support, Peterson International Underwriters reaches out to all insurance advisors, providing them with the proper tools to help their clients protect their hard-earned paychecks. And Todd, I'm going to go ahead and turn the time over to you. And here we go.
Thank you so much. And I appreciate the opportunity to present today. And for those of you that are joining us live and will be watching via the recorded version in the days and weeks to come. One of the biggest things, I deal a lot with income protection, also known as disability insurance. And I don't like calling it disability insurance because I think the word disability has a negative connotation. But the question that I like to ask a lot when I'm doing webinars and in-person training sessions is, why is income protection important? And then I'll just be quiet for a little bit. What does your income mean to you? Well, think about it. Everything that we do is a function of our income. It doesn't matter what your job is, who you are. Our lifestyle and everything that we do is based upon that income. And the question then becomes, what happens if that income were to be shut off because you were too sick or hurt to go to work? And, a lot of people respond, well, I could do this and I've got savings and, I'm making really good money and my investment rep can help me out and this and that. Okay, so is that what those particular items were intended for? Do you want to drain your savings? One thing that we know is that many Americans today live paycheck to paycheck. And if you are really, really good about saving and you save 10% of every paycheck, that 10 years worth of savings would be wiped out in 1 year of a disability. Think about that for a second. Is that really what your savings was for? Probably not. A lot of times we hear too, well, I could live off my spouse's income. That wouldn't be a problem. Okay, have you talked to your spouse about that? Probably not the best idea. And the other factor is too is your entire paycheck going into the bank or going into investments and you're not touching it at all? So what it comes down to is if we have a shortage of income because someone is too sick or hurt to work, we're going to see a lifestyle change. And when we're talking about you in particular as physicians, you guys have worked extremely hard for your education and to get where you're at. There's no type of occupation out there that goes through as much schooling and as much training as a physician does. And the bottom line is there would be a dramatic lifestyle change if that income were to cease because you are too sick or hurt to go to work. A lot of times so Peterson International Underwriters is a cover holder for Lloyd's of London. We do what we call excess disability insurance. So our job is to help out when traditional carriers can't or won't. And so what we're finding a lot of times, and we'll visit about this more in a little bit, but we want to stack coverage for clients who can qualify for that coverage. We are not out as a cover holder to replace anything that's out there. We want to see if you've got a group plan, hey, great, leave it in place. If you've got traditional carrier individual coverage, leave that stacked on top. And then Lloyd's comes in and plays tier 3 and above to stack on top of that. So what we're going to typically find is you've got a nice base layer of group to start if it's available to you. That covers a lot of times the first $5,000 to $10,000 of income protection. Then you would go to an individual disability carrier plan. Those would be, again, the people that you're seeing advertising on TV a lot of the time. And they're going to get you to a certain number as well. But if you are a high income earner and your income justifies that you need more than that, that's where Lloyd's and other cover holders such as Peterson step in, is to stack on top of those two layers and provide the additional income protection that can't be covered through the group plan or the individual disability plan because of the limit of dollars that they're willing to provide to you on a monthly benefit.
And you mentioned Lloyd's. Is it available any other place?
No, literally Lloyd's, above and beyond what the traditional carriers are willing to offer, Lloyd's is the only place that you can go to obtain that coverage. You could call multiple carriers in that traditional carrier space and say, hey, I already have this amount of coverage in force. What can you do for me? And they're going to say, you've got the most that we can potentially offer you as well. So there's nothing we can do for you.
All right. So I appreciate you going over this. Can you talk a little bit about what about people who, they're covered entirely between their group and their individual?
Yeah. So if you are properly covered at 60 to 65% through your group and individual disability plan, there's really no need for a Lloyd's excess layer in there. Again, the excess layer is, again, for the high income earners. No matter what your occupation is, it doesn't even, what if you're a high earning attorney or CEO of an organization? It doesn't matter what your occupation is. If you're making more than what the traditional carriers allow, that's where the Lloyd's excess layer comes into place. We can't and we won't step in and try to replace that group plan or individual plan, literally by law, because of the way our surplus lines coverage is offered through the excess lines.
And I think we talked about this a little bit before the webinar, that the education piece comes in here, that a lot of people don't even know that this is available.
That's 100% right. If I had $1 for every time that said, oh my goodness, I didn't even know this, you guys did anything like this, I could probably retire already. So yeah, that's the kicker, is that a lot of people just don't even understand that this additional layer of income protection is available to them because of the amount of money that they may happen to be earning.
One more thing, you had mentioned Lloyd's, but you didn't explain exactly how Lloyd's comes into this.
Yeah, so Peterson International is a cover holder for Lloyd's of London. Being that this is excess coverage and it's a non-traditional carrier, Lloyd's is a marketplace, and I kind of liken it to the New York Stock Exchange. New York Stock Exchange is a marketplace as well. You can't just directly go to New York and buy stock directly from the New York Stock Exchange. You have to find a broker to go do that. Well, same thing with Lloyd's. You can't go directly to Lloyd's of London and say, hey, I want this type of a policy, and they just go, okay, yeah, sure, no problem. You have to have a broker or a cover holder to get you there. So let's talk about the parts of a disability policy. When we talk about the parts of a disability policy, sometimes a lot of this doesn't have to be explained in the physician market, because you guys and gals have been marketed to so heavily throughout the process of your residency and fellowship and things like that. But just to recap, that way we're all on the same page. Let's talk about these parts of a disability policy. First, we have an elimination period. The elimination period is really your waiting period. That's the amount of time from the instance that occurs, whether it's the sickness or the illness, that deemed you unable to go to work. A lot of times what we find is that number is typically 90 days. It doesn't have to be 90 days, but it can be 90 days. And so once we've hit that elimination period, then the insurance company starts paying out your benefit. We have a benefit period, and that's the amount of time that if you go on claim, this is the number of times that the payments would arrive to you if you're still unable to go to work. And depending upon the carrier, the type of policy you have, so on and so forth, these types of benefit periods can go anywhere from 1 year to 2 years to 5 years to age 65 and even all the way to age 70. Typically what we find in the physician space is usually it's an age 65, age 67, or age 70 type of benefit period that we see. Now, here's where Lloyd's is a little bit unique. The way that we pay out a benefit, it would be a monthly benefit for 5 years. And then at the end of 5 years, if you are deemed to not go back to work doing whatever it is that you were doing, whatever your specialty was at the time of disability, we pay a lump sum benefit equivalent to age 70. Our thought process behind this is, listen, if you haven't been to work in 5 years, what's the likelihood that you're probably going to be returning back to work? Probably pretty small. So let's just pay out the benefit to you. And the policy is terminated. These benefits typically come to you tax-free. And with these lump sum benefits, they can literally be in the millions of dollars. And what that does is it provides you an opportunity too to go invest that money because you may not need it all right away. Typically that's not the case. So you've got a chance to go earn money on tax-free benefit that an insurance carrier has already paid you. The benefit amount. This one is always a little bit tricky because it's not just an amount that they're willing to pay you. It depends upon your occupation. It depends upon your actual income. That's obviously number one is income. So when people think, that they're going to get 100% of their income replaced, they're wrong. If an insurance carrier was ever to do that, what's the incentive to ever return back to work? It has to hurt a little bit. And most traditional insurance carriers will pay around 60 to 65%, sometimes a little bit more. But when we think about the after tax and after benefits types of take-home pay that you're receiving, that's roughly 60, 65% in that neighborhood typically. So that's the amount that we're talking about. Now, again, and we'll talk about this in a minute too. What we want to do is get that client to a true 60 to 65%. And otherwise, again, we're going to see some sort of a lifestyle change. But then we also run into, from an underwriting perspective, some potential policy exclusions. And these would be things that have occurred to you through sickness, accident, medications you're taking, preventative medicines, and things like that, that you come to us with prior to the application being signed. So as an example, if I'm let's say type 1 diabetic, or a better example would be type 2 diabetic, right? And you're controlling it with medication and your A1C is great, so on and so forth. What the carrier may do is they may rate up your policy a little bit because of that. If it's uncontrolled, they may put an exclusion for diabetes on there. Or let's say that maybe you had a really bad knee problem and you had some extensive surgery done last year. Well, there's not a lot of time in there, from a underwriting standpoint to say, hey, Dr. So-and-so is back to work and this and that. Well, there could be lingering issues going on with that knee. So they may put an exclusion on the knee because you previously had surgery on that particular part of your body, so on and so forth. So it's kind of, I liken it to car insurance. My example of that is, listen, if you go out and buy a car that had a hail dent in it and you bought it that way, do you expect your insurance carrier to go fix the hail dent for you? Well, no, of course not. You bought the car that way. Well, same thing with a disability policy or an income protection policy. If you had a surgery for this, or you're taking medication for that, you came to us that way. We have to protect ourselves from a potential claim with something that may already be going on with you. Again, not everything is excluded. We leave that up to the underwriters. And the nice part is that when you do apply, prior to the application, a lot of pre-screening can be done to say, hey, here's where we think that you're going to fit in. Is this okay with you? Yeah, there might be an exclusion for your knee. Are you okay with that? If not, then let's not deal with the hassle of applying. Now, to me, if it's just an exclusion on the knee, I'm taking that all day long, because what people don't realize is that 90% of disabilities actually occur from sickness, not from accidents. And in our own head in the public, they think it's actually the other way around. Well, it's because of this accident or this accident and this and that. No, it is sickness related. 90% of all disabilities are sickness related. So in a nutshell, those are the parts of a typical disability policy. Well, as a physician, you really need to think about some special considerations. Like, do you have a specialty? Well, if you do, okay, what your policy says and the policy language is very, very important. You want to protect that specialty. What are your day-to-day activities? So when an underwriter or a claims analyst is looking at issuing a policy or potentially putting you on a claim, they're going to say, well, okay, what does Dr. So-and-so do on a daily, weekly, monthly basis? How much percent, or what percent of their day or what percent of their week is spent doing surgeries or this and that, or reading records and this, these major, being in front of patients, all of the things that you're doing on a daily to weekly basis, that comes into account. If you are disabled, would you be able to continue in that specialty? Well, hey, listen, if I'm a surgeon and I had to have that major knee surgery, am I going to be able to stand up and perform those surgeries? No, likely not. And I've seen it before many times. It's not going to happen. So you have to be able to perform literally at 100%, or you have the potential to go on claim. Now, as you can imagine, not all policies are very specific. And so what we find is that the definitions can be a little bit too broad. And when I say that, that typically comes into play when we're talking about group plans. So these would be the things that you would find through your hospital system, or if you have a larger employer, so on and so forth. That's where you find maybe the first $5,000 to $10,000 of income protection in there. Those usually have a pretty broad definition of disability. When we get into the individual disability carriers, again, the people that you're seeing on TV doing those advertisements and things of that sort, that's where you find a much more specific definition of disability, and it revolves around what we call your own occupation or your own specialty. That's what you want to find, and that's what you want as a physician, is something that states your own occupation. So this is how it would end up working. If you are unable to do your specific job duties, you are considered on claim, even if you can go do another occupation and earn an income. What you don't want to have happen is to say, well, yeah, you can't do your specific job duties, but you could go do something that you have been trained or educated to do. Well, wouldn't that, with all of the training and education that you've been through as a physician, doesn't that leave a pretty wide scope of things that you could potentially do? Listen, if you have trained to be an orthopedic surgeon, that's what you want to do. You don't want to have to go teach classes at the university because you've been trained to be a doctor, so on and so. No, I want my definition to say, listen, I am the orthopedic surgeon. If I can't perform my surgery and I can't see patients and be in front of these people, I want to be on claim, and whether or not I choose to go do something else and earn an income. Most people, it doesn't matter what their occupation is, most people choose to not go out and find another occupation if they are on claim. So again, you want to be very, very specific. The Lloyd's carriers, being that we're stacking on top of these group plans and individual plans, we have that specialty own occupation definition. It would be a complete black eye for us to say, well, you met your group plan and your individual plan, but you didn't meet the Lloyd's definition for disability. No. And in fact, Marcia and I were talking about this before the webinar started today. A lot of times it's the other way around. The Lloyd's carrier will pay out, the individual carrier will pay out, and it's the group plan that kind of, because they've got that broad definition of disability, those are the ones that sometimes are a little slow to pay out. So again, consider that specific definition of disability because it's very, very important for you as a physician if you have a specialty that you are practicing. So here's where the Lloyd's piece really comes into play. And this is really what we wanted to speak to you about because this is something unique to you that you may not be aware of how we function or what's available to you from your income protection standpoint. Most base policies have an upper limit where they call it a benefit cap. And if you really want to get technical, in traditional carrier sense, they call them issue and participation limits. Basically, there's a number that they are willing to offer you. And when you get to that number, they're not willing to offer you anything more. So as an example, your group policy would be, as an example, it may say 60% to $5,000. Okay, great. Well, that means that's a $100,000 income. All right, 60% of $100,000 is $5,000 a month. Well, but what if I'm making $1 million? Okay, that group plan is not going to be enough because 65% of $1 million a month is $83,000 a month. Or sorry, it's $65,000 a month. I apologize. Okay, so there's a giant shortfall there. Well, so again, we've got the group plan. Then you want to go look at your individual carrier coverage. Well, being that a lot of producers who are out there and a lot of the carriers that are out there, they've got a high concentration of physicians already, and the carriers know this. So they want to limit their risk a little bit. They'll say, hey, we will offer you a policy, but with all of your disability coverage put together, we won't offer you anything more than $25,000 as an example. The highest I've seen it is $30,000. But most traditional carriers will go 20 to 25,000, all carriers in. So if you already have 5, they're going to offer you another 20, and then they're going to say, sorry, we can't help you out anymore. Okay, well, great. So now I'm at $25,000, but again, I'm accustomed to bringing home $56,000 a month as that the 65% of $1 million is 56,000. Apologize for my math a minute ago. So we're at 25,000, but I need 56,000. That's a giant shortfall still. Well, that's where Lloyd's comes into play. We are not out to replace the group plan. We are not out to replace the individual plan. We want those in force, and we want to stack on top of those two plans and offer the difference. So if you're at 25 and you need 56, we're going to offer you another, what's that, $31,000 a month? Yeah. So we're actually offering more than the other two plans combined. But our goal, as you can see on your screen, is to get to a recommended coverage of 60 to 65%. So this additional policy is going to cover that amount that is not covered by your traditional carrier source. So that's what we call excess disability insurance or high limit disability insurance. We're there to make up for that difference in addition to what other coverages you already have in force. So then the next question comes up, well, how does somebody typically qualify for these benefits? Well, as we mentioned a little while ago, they become sick or hurt, all right? And now you're unable to perform your job duties. That's how a disability claim starts. You have to satisfy your elimination period. Ironically, your attending physician says, hey, Dr. Smith has not been able to attend work since May 1st. Okay, okay, fantastic. Well, that May 1st just started my elimination period. So if my elimination period is 90 days, I need to satisfy that 90 days, and then I will go on claim. Now, here's the nice part about every disability policy that's out there. Once you hit your elimination period, you are no longer responsible to pay your premium. They call it a waiver of premium. So you're literally getting all of your benefits coming to you, but you're not paying for the actual premium while you are on a claim. So that's a really nice benefit. Here's another thing to keep in mind too. We talked about the taxability piece of it. I am not a tax advisor, but this is typically how this works out. If you are using after-tax dollars to pay the premium for your policy, the benefits come back to you on a tax-free basis. If you are using pre-tax dollars to pay for the premium, those benefits that are coming to you are actually taxable. You got to remember, Uncle Sam wants their part. And so we can pay them a little bit of that part on the front end during the premium, or we can pay it on the back end. If I've got as an example, if I've got a $100 premium every month, I'd rather pay taxes on $100 than pay taxes on a claim when I need it the most, and I'm paying for a $5,000 extra monthly benefit as an example. So you keep that in mind. Post-tax dollars for the premium make tax-free payments when it comes time for a claim. Now, there will be follow-up to remain on claim, and your carriers will help you out with every step of that, but they will check on you to every 6 months or so to make sure that hey, you're still truly unable to work. You are seeing your attending physician and following up in that regard, so on and so forth, and see how you're progressing to potentially getting back to work and seeing if they can get you off of claim. So there is some things that will occur as that claim process moves on. Now, the question is, can everybody qualify for this disability coverage? The answer is actually no. No, there's not. And some of these things apply to you as a physician, some of them do not. But what we run into is that carriers say no because of health, age, occupation, and maybe even avocation. If you've got a wild hobby that you like to do, maybe you like to skydive, maybe you like to scuba dive and go deeper than recommended tolerances and things like that for their underwriting guides, things of that sort. So again, when the traditional carriers say no because of health or because of the age, occupation obviously doesn't matter because you're a physician, or the avocation. If they say no because of those things, then the Lloyd's market is there to step in and help you out and say yes because of those particular issues. So I talked about type 1 diabetes earlier. There's a big difference from an underwriting perspective between type 1 and type 2 diabetes. Type 2 diabetes can be controlled with diet and some medication. Potentially it could end up going away, not likely, but there's that small potential out there, from what they tell us. Type 1 diabetes never goes away, and traditional carriers don't like type 1 diabetics. They will just say, no, thank you, potentially too many risks, cardiovascular issues, things of that sort. Well, because they just said no, we're willing to step in and say yes. Maybe you've had a cancer history. Maybe you've had some cardiovascular issues, whatever it might be. If they tell you no, that's not an acceptable answer. The Lloyd's market is there to step in and help you out when we run into that unfortunate word, no. So then it comes down to, well, how are costs determined? Is this a crazy expensive policy? I mean, it sounds expensive. If you guys are offering, tens of thousands of dollars, potentially millions of dollars in lump sum benefits, what do these policies typically cost? Well, our ultimate goal is to try to stay between 2 to 4 to maybe even 5% of your income. So the question is, would you spend 5% of your income to protect the other 95% of it? The answer has to be yes, right? And costs are determined mostly by age, by occupation. So higher the age, the more expensive it's going to be, right? The longer you wait, the more expensive it is. So buy it early and buy it often. The occupation comes into play. Now, in our world, a physician is not just a physician. If you have more exposure, you are going to pay a little bit higher premium. So an example would be, would a neurosurgeon pay the same rates as a general practitioner? Absolutely not, right? The neurosurgeon has more exposure. The anesthesiologist has more exposure than the general practitioner. They're going to pay slightly higher rates based upon their specific job duties. The benefit amount. Obviously, the more benefit you request and the more that you qualify for, the higher your premium is going to be because the potential to pay out higher dollars in claims. When it comes to an elimination period or that waiting period, the longer the waiting period, the lower the premium. The shorter the waiting period, the higher the premium. Again, if the carrier pays out faster, they're going to charge you more because of it. And then the benefit period. The longer you could remain on a potential claim, the higher the premium goes. And the shorter the actual benefit period, then that's when the premiums end up going down. You're going to pay a higher premium for an age 65 policy than you would for a 5-year benefit period. That's just a known fact from an actuarial standpoint there. So That's pretty much how costs are determined. Pretty straightforward when it comes to that. And then what does the application process look like? Well, you're going to have a paper application, and then you're also going to have, after that's filled out and sent into your carrier, you're going to get a paramedical. It's height, weight, blood pressure, and a urine specimen. And that can be taken care of at home. It can be taken care of at your office. You can go to the paramedical facility if you want to, so on and so forth. It's a very easy process to go through. Your underwriters will then take a look at all of that information, put all those things together and say, hey, yep, we're willing to offer you this policy. And then the offer is made to you. It's a very easy process. Typical times for a what we call fully underwritten application where you have to have the paramedical done. It takes anywhere between 3 to 4 weeks typically to get that entire process completed and get an answer on whether or not the carrier is willing to take you on as a client. I want to flip gears for a second because I think this is really important, especially in the physician world, and it's not talked about a lot. So everything that we've talked about to this point has dealt with personal income protection. Well, what about the business disability side of it? What happens if a key person or a partner, if that applies to you, becomes disabled? What if you're a sole practitioner? So you are the key person, you're the rainmaker. Well, what happens to the practice if you become disabled? Or what happens if I'm in a partnership and there's 3 of us within our practice and Dr. A happens to become sick and can't work for a while? What we find a lot of times is that buy-sell agreements are created, and these buy-sell agreements are typically funded with life insurance. Well, hey, fantastic, great, but what if the partner doesn't die? What if the partner becomes disabled? So a lot of times what they'll do is they'll write in, hey, due to a death, right? Or due to a 1 year or 2 year typical hiatus due to a disability, then the buy-sell agreement kicks in. Well, do the other 2 partners want to pay out of pocket to fund that buyout? Or would they rather pay a little bit of premium to have the entire benefit, that amount of the buyout be funded by the actual insurance carrier? That's what buy-sell agreement disability policy can do for you. Or a key person plan, which is very, very popular. You tell us who the key people are within your organization, and we put a policy on them, and all of the benefits are paid back to the business. It could be on you as the physician. It could be beyond a key staff member, or again, you name it. You tell us why they're a key person, and we can create the policy for them. That's not a problem whatsoever. But what I like about it is, again, that benefit is payable right back to the business, and then you get to decide how that benefit is used. There's no questions asked. We don't care after that point in time. All we care about from a carrier standpoint is the benefits are paid back to the business. And then again, you can use them for a replacement for yourself or that key person. You can use it for marketing so you're not losing clients. You can use it to pay payroll, things like that, if that's really what you would want to do with that money. So something to think about there. Again, a lot of times key person, again, and the buy-sell agreements are funded through life insurance, but we're not really thinking about them from a disabling event standpoint. What happens to the business if that person's out for an extended period of time? How are we going to buy out this person in the event that they don't die, so on and so forth? These are questions that need to be asked, and your insurance professional can help you out with those. And with that, I would be happy to open it up for any questions.
Yeah, we do have a couple questions here. How prevalent is it that someone becomes disabled? Can you talk to maybe the statistics of that?
Yeah, so independent organizations that have no affiliation with any carrier, they're nonprofit, so on and so forth. Studies show that 20-year-olds that are entering the workforce actually have a 1 in 4 chance of becoming disabled for at least 90 days during their working life. So think about that. If you had a 1 in 4 chance of winning the lottery, would you buy a ticket? Right? Of course you would, right? And what people don't realize is that I haven't seen the stats for the last couple of years, but I can't imagine it's changed much. From a carrier, because the carriers report this stuff back to these independent organizations too, from what they find. If a client does go on claim and they are out for at least 90 days, the claim usually lasts for just shy of 3 years. So, think about that again. We talked about what would that happen? What would happen to you if you didn't have that paycheck for, well, when you include your elimination period, you're not going to have a paycheck for slightly over 3 years. It's going to hurt. So, yeah, it's frequent, and they do last for quite some time. And one thing that I didn't really mention in there too is that you are allowed to go on claim for multiple things. It's not, hey, I go on claim and I may be out maybe for my 3 years or whatever, and I return back to work. Your policy is not over. You can maintain your policy. You just pick up payments again from that time moving forward. And if you go out for another reason, you're more than happy to submit another claim and go on claim for that too. So we've had many clients that go out on different claims for multiple reasons too.
Speaking to kind of what you had said before about knowing about your policy, how can you get your policy analyzed? Not many people are going to sit down and read that entire thing. And even if they do read it, they may not actually know what it actually means.
Right. Yeah. That's kind of like me trying to read medical records. It's a little foreign to me. Yes, get all your policies together and take them to your insurance professional and say, hey, help me out with these. And you know what? And sometimes too, if your particular advisor is not dealing with income protection insurance on a regular basis, they may need to say, hey, I need to refer this back to my general agency and have them help me break this down as well. So, there's an avenue there to have those all reviewed. I think it's a great idea and a great process just to make sure that you're not exposing yourself to any undue headaches when something were to occur and you're in need of that cash flow and that money. Make sure that all the ducks are lined up right before that event occurs. And so if anything were to ever happen, it should flow smoothly from there during that claims process.
We had another good question here. So, can you work part-time or maybe in a different job and still collect benefits?
So yeah, great. That's a great question. It depends upon your policy and the provisions that you put in with your policy. You can add in what they call riders to the policy to say this is covered and this is covered and this is covered. And again, your broker can help you out with this. But they do have what they call a partial, and some carriers call it a residual disability benefit, where it's based on loss of income and not loss of time. So you don't have to be fully out of work in order to go on claim or maintain a claim. So as an example, if something were to happen to you and maybe you're only able to work 2 days a week instead of 5, well, that means that you're going to show, that's you're only working 40% of the time. You may show a 60% loss of income. Well, your policy with the correct provisions in it would pay out 60% of the actual benefit because you're showing a 60% loss of income. Or if you're showing a 50% loss of income, it pays out 50% of your benefit. So that's a fantastic question. Those provisions are available to you. And again, it depends upon the policies that you already have in place or that you may be looking to purchase.
Well, I think that's all the time we have for questions today. And I will tell our attendees if they have any more questions, go ahead and leave those in the chat. And I will save that chat. We'll reach out to you if we can address those. I want to thank Todd for being here. And oh, that's the wrong slide. Just a second. Here we go. Thank you, Todd, for being here and for explaining all of this information. I'm sure you could go into much more detail.
Oh my goodness.
This is just this overview
Yes.
for our people today. For our attendees, look for an email soon for a link to a replay of this event. And you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon.